Hello everybody. So a lot of people recently have joined the channel to get my strategy updates, but I cover all sorts of stocks, and some of the older stocks of the channel have been small caps and trying to find alpha in small caps. So today I want to discuss two small caps that I own in my portfolio and that have been popping quite a bit over the past few weeks. And I want to use this as kind of an educational opportunity to talk about what it takes to own small caps, because CorMedix, actually, someone in the comment section was telling me, I can't believe I would be behind this beep or like some sort of a word about CorMedix. And it's funny, they wrote that in the comment section when it was trading under 10. And you can see it was under $10 for quite a while. And then all of a sudden, it just bounces right back, right? And perhaps the first clue should have been, a company that's growing at well over 50% a year after year, shouldn't have a P ratio of 5. Perhaps that should be the first clue, right? Perhaps this is more of a P ratio of a mall, a store, a clothing store going out of business, but not the P ratio of a patented product that is being taken over and that is taking their own sector by storm. So way too low just looking at the PE. Anybody could see that. But the market is irrational. The market is entirely silly. And if you look at KULR is ridiculous. Over the past 19 days, KULR is up 74%. So before I talk briefly about these two, what are small cap rules? So these are small caps. Both of these are under $1 billion. And the only reason why CorMedix is now $900 million is because they did an expensive $300 million acquisition. That's why they're bigger. But initially, these two were about the same size. And so there's a few rules. Rule number one is no options. Or maybe if you want to take risks like I do, maybe do 900 days options. Maybe. But even then, try to limit them to maximum. And I know it's tough. I know the common oftentimes doesn't look that sexy, not that attractive to buy the common. But no options is so critical on small caps because they can be undervalued for years. You may be sitting on a bag for years. And by the way, that's true. I mean, nowadays that's true of a big caps too. Think about Tesla. How many people owning Tesla just sat on a bag for years and years and years? Like Tesla, depending on when you bought, you could have been in the red for 3 years. So this is true for all stocks, but this is especially true for small caps, and I guess for Tesla. Right? Expect insane volatility. Again, this is historically more true for small cap stocks, but more and more you have big cap stocks reacting like this. The algos are nuts. You may remember NVIDIA, the DeepSeek scare. You may remember April, the largest intraday drop. A few days after Liberation Day, the largest intraday drop in the history of the stock market. That was April, right? So it seems like volatility is part of the game, but historically, small caps are supposed to be more volatile, which they definitely are, but big caps are volatile too. And then expect exceptional anomalies in valuation. I'll get to that when I get to KULR. KULR was trading for free at one point. The underlying business of KULR was trading for free. This is the same as Mara. Mara, depending on the day, sometimes is still trading for free for less than their land, less than their equipment, or less than their transformers. The market is just basket trading baskets of stocks and throwing the baby with the bathwater. So let's briefly talk about these two stocks, which I guess, very rebounding. We're happy about that. So CorMedix. So, on my little spreadsheet that I have on Patreon, I show my current favorites. And CorMedix, if you follow the channel on a regular basis, you don't need to have a Patreon. HIMS is a favorite. HIMS has been a favorite for years. Reax, I like Reax a lot right now. But you can see, if I compare CorMedix, that's why I like CorMedix so much. CorMedix is 3 times cheaper than either HIMS or Reax. 3 times cheaper for a rule of 40 of 161, a rule of 40 that is higher. The EBITDA margin is 41%. They literally print cash. The gross margin is 96%. Forward revenue growth estimated is 120%. And that is because they acquired Melinta, which grows just a tad slower than their core product, DefenCath. And the last call, they raised the guidance. Not the first time they raised the guidance. They raised their guidance for 2025 to, let's call it, middle 400 million. 400 million is the guidance. Trailing 12 months, 214 million in sales, trailing 12 months. So they're literally guiding a doubling in sales. And this stock is trading, if you like PE, this stock, like I said, PE ratio of 5.66. Like, that should be people's first clue. You have a stock growing at 100%, and then the PE ratio is 5, because the basket of stocks, people believe, like traditional healthcare companies, well, first of all, there is this issue with biotech. Not all of these companies are biotech, right? CorMedix, I do not consider a biotech. It's not a risky pre-revenue company that depends on phase 3 approval. But in the basket of stocks, they're put as biotechs. And so people say, oh, biotech bad, risk off. I go risk off, I don't want to buy biotech, right? Not the case for CorMedix. And there's quite a few, actually, and if you follow the channel, you know I like other ones. Like, I like TGTX, I like Delcaf. There's other stocks that I like in that sector, which are dirt cheap for, frankly, not a lot of reasons. Like, the reasons make very little sense. As a reminder, I've covered CorMedix multiple times on this channel, but as a reminder, CorMedix, their main product is called DefenCaf. It's an anti-infection product. When people go on dialysis, i.e. the end of type 2 diabetes, you have uncontrolled diabetes, it's bad, it's, you're in your 60s, in your 70s, you have type 2, it's uncontrolled, you gotta go to dialysis. One of the leading causes of death when you go to dialysis is an infection related to going to the dialysis, because the catheter just sits there for 3 days and you go about your life for 3 days, and sometimes you get an infection inside of it. So their product is a fluid that you put into the catheter to lock the catheter and reduce the risk of infections so the patients don't die. This is a product which right now goes for $249 per vial. And it's a product that saves a lot of money for Medicare. And it's a product that makes money for dialysis centers, because dialysis centers get reimbursed more money when they have fewer infections. And this company has two customers, the two main large dialysis organizations, the LDO. Both of them are their customers, and it's simple. There's two of them, Davita and Trinicius. That's it. These are the two customers, and they're just printing cash. And yes, they have to renegotiate the pricing. And we don't really know what the pricing per solution lock is going to be. Probably around $100 a vial is what I hear on the grapevine and I see. But guess what? This is what I estimated a year ago in my video. The market, and they're the only product approved, the market alone for this product could be $10 billion in sales, right? At $249 a piece. So even if they cut that in half, that's still $5 billion potentially at maturity that could accrue to this revenue, right? And the FDA, well, not the FDA, but here, but it's the only FDA-approved lock, so you have kind of that moat rent-seeking part, but also Medicare as an incentive to reimburse these products, because these products reduce infections, and infections cost, between $70,000 and $100,000 to the taxpayer. So they want to avoid that at all costs. And so I think this is a product that's going to keep being very successful. And then riding on the success of this cash printing product, they bought a diversified company that is in the same sector of anti-infection, right? And that's why the new motto of the firm is to prevent cardiac, renal, and infectious diseases, right? So they bought a company called Melinta, who has very similar product, which are all about avoiding infection, antifungal, antibacterial, inhibitor of, some UTI-related issue, antibacterial, beta blocker. So they are trying to be a more holistic, preventative healthcare company that deals with people not getting infections and bacterias and diseases like that you usually contract, at hospitals or nursing homes or, dialysis center. To me, it's a very clear business model. It fits. They have synergies. The salespeople for DefenCaf, they're going to be the salespeople for the same product, right? DefenCaf, their big growth beyond the $10 billion I'm talking about here is also selling it to TPNs. So you know TPNs is a feeding patients with a catheter. When you feed patients with a catheter, sometimes the patient goes home or whatever, or they have to visit a few times. You can sell this anti-infection disease there too. So that's another aspect, and that's a big area for growth because there's a lot of hospitals and the population is aging. It's a great product, but again, if this company was trading at a 0.2, I wouldn't be interested. I wouldn't be talking to you about CorMedix if it was trading at a 0.2 or 0.3. And there's plenty of companies who are just as interesting as CorMedix trading at a 0.3. There's only a handful that are this good trading at a 0.03. 3 times cheaper than him. So that's why I love it. I think despite the run of 23%, I think it's still dirt cheap. I own this stock for the long run. KULR. Let's talk about KULR. So KULR is another special case of undervalued. So KULR, I was first attracted to KULR. What is KULR, first of all? KULR is a pre-revenue company. KULR is well, I guess they do a little revenue now, but it's a pre-cash flow. It's a negative cash flow company. It's a company that is very early on. It's your typical Cathie Wood stock, and she doesn't own it, by the way. I checked, but it's your typical Cathie Wood stocks. You're losing money. You're ramping up the sales. You're ramping up the production. You can see KULR talking about the growth in their production. It could be tenfold their energy storage. They're building a new plant. They're expanding a plant. They're growing like a weed. They're growing left and right. And so that takes a lot of money. And so it's a money-losing company at this point, right? And of course, I wouldn't be interested in it if it were not for the fact that this company just a few weeks ago was trading below the value of the Bitcoin on its balance sheet. And that was a few weeks before the bottom. Bitcoin was trading at 100,000 at about this level. And I was saying, is the business really worth 10 million? Well, the value of the business actually went negative for a few days on KULR. It made absolutely no sense during this liquidity crisis. This business actually went negative. And this is because, for some reason, this business got associated with the digital asset treasury company trade, the DAT trade. And of course, being baskets of stocks, people just say, oh, we're going to sell KULR because KULR is all about the DAT trade. So we're going to sell KULR, and you end up in a situation where the actual business with tangible products, with security clearances, with customers in the Department of Defense, with batteries on the moon, batteries on Mars, with thermal runaway systems, battery management systems that can actually go in satellites and that are radiation resistance, really deep tech type stuff, was trading at a negative value. Right, Michael Moe has been building this company for well over a decade. If you look at the peers of KULR, like Amprius, for example, what I would consider the peers of KULR, they are trading in the stratosphere. The valuation is in the stratosphere, but not for KULR, because KULR, for some reason, has this association with a Bitcoin company, and so that's why when I look at this company, I'm like, this is very, very dirt cheap. I typically don't do pre-revenue company. I typically will always tell you and say that space is just a tad too early for me, but not when I have the margin of safety of the Bitcoin. When I have the margin of safety of the Bitcoin, I love the company. And if you see this company when they SPAC'd at $10, and you're still looking at a 4x from 2024. And when they bought Bitcoin, they went up, and then they went way back down. And of course, they overdid it because they dropped more than when this company had nothing to do with the value of Bitcoin and with Bitcoin. So, and of course, Michael Moe talked about what they did to Bitcoin. Bitcoin, I mean, good for them. This is so wonderful. They have so much Bitcoin on the balance sheet now. Like this is a solid way for them to finance the growth of the company. They can borrow against the Bitcoin. If Bitcoin goes to, quote unquote, the moon, they can sell a part of the Bitcoin to finance their operations. That was a very good move from Michael Moe, in my view, to do that. And we're seeing a disassociation. We're seeing a disassociation with Bitcoin, because if you actually go and I don't have a chart of Bitcoin here, but if you were to compare the chart of Bitcoin over the past 19 days, we're down. KULR, we're up 74%. So there's actually a delta of about 80%. There's a divergence of about 80% between KULR and the price of Bitcoin. So the market is finally seeing KULR for what it used to be before Bitcoin, but you can see the market got entirely irrational, selling this company for less than the value of the Bitcoin. And you know, it's an anomaly. There's more anomalies out there for sure, but these are the two I wanted to talk about today. So anyways, hopefully it gives you an idea into what I think it takes to own small hyper-growth caps. This was not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.